everyone, how's it going? Welcome back to Lunch at the Market. I know it's been forever, right? Well, with the government basically getting all up in everybody's business, we really haven't found that many exciting reasons or ways to trade. So, with the fiscal cliff behind us and our next government crisis isn't until March, why don't we buy something or trade something or sell something or do something, right? Okay, so everybody seems to like Facebook these days. So how do you play it? Well, if you look at the options market, there's some massive premium in them there options. Out of the money options in Facebook are insanity, and when you add the out of the money price plus anything in the money, you just pay an exorbitant amount for Facebook options. So how do you play it if you believe that Facebook will go higher? We like the 25, 30, 32 lopsided call butterfly. Now, what does that mean? Well, normally you do something like a 25, 30, 35 call butterfly. That means that both wings are equally spaced. Well, we've been burned in the past when something blows all the way through your strike price, right? All the strikes in your structure, and then your structure is worth nothing. And that's painful. And you can only have so many of those trades before you just lose a lot of money. We don't like doing that. So here's how you play it. You make your long wing bigger than your short wing, okay? So this is $5 wide, hence you're basically buying a 25-30 call spread, and then you're selling a 30-32 call spread at the same time, okay? So it means that, you know, one wing is big and the other wing is small. Can you see that? Yeah, that visual doesn't really work. Okay, it's like this. There we go. Okay, this wing is $5 wide, and this wing is $2 wide. So it only makes sense to do this if you can buy the whole thing for your worst case scenario. Your worst case scenario is it blows all the way through all the strikes, meaning Facebook is above 32 by January expiration, which is next Friday. So it's a really short-dated trade, but here's why we like it so much. The whole structure costs about $1.70. Yeah, that's right, $1.70. Okay, your worst case scenario, meaning the stock is above $32 a share. Well, actually, your worst case scenario is that it drops all the way down below 25. But at this point in the game in Facebook, that would be a major turn of events. So the other worst case scenario is that it goes all the way through the 32 strike. Your $5 call spread will be worth $5, and then you'll lose $2 for your short $2 call spread. Net, $3 is what you're looking at this trade being worth if the stock is above $32 a share. That's fantastic, because if you pay $1.70 and it's worth $3 next Friday, that's pretty close to 100% return. I don't know about you, but I like those kinds of odds. Here's the other thing I like about it. If the stock finishes below $30 a share, not only are you in really good shape, meaning your break even is only like $26.70, which means the stock could fall pretty significantly from here, 10% or so, and you still break even on the trade, not bad. The other thing is, if it stops somewhere right around $30, your full profit on this thing is $5, and that's a multiple bagger if you end up with that. Here's the other great thing. Let's say you still like Facebook, but you want to stay in the trade. If the stock finishes below 30, everything above 30 is completely worthless, okay? Then you roll out your January strike that's in the money, and then you resell basically a ratio spread. You'll sell 2 calls, and then you'll buy another call above it, okay? So you'll roll it out, you'll sell 2 more. That's a good way to make a lot of money. In fact, we did this with URI last year, ended up with a huge return on it, okay? So that's a good way to consider how to play Facebook. If you have any questions, hit us up on Twitter at MOFinancial when you watch the video, or put some comments in the comments section here on YouTube. Thanks so much for joining us today on Lunch at the Market. Have a great day.